What is going on, everybody? Welcome back to Trading Learning 101. Today's video, we are going to talk about short sale restriction, SSR. This thing right here. The importance of knowing about short sale restriction, the uptick rule, the plus tick rule, the tick test rule. When do they activate SSR? Why you should know about this as a trader. So let's jump into it. I'm sure you guys heard of SSR or have seen it on your level 2 charts or have heard traders mention SSR, short sale restriction, is activated on a stock, and ask yourself, what are they talking about? I'm going to give you guys a walkthrough of what SSR is, and then we're going to go to Investopedia, and I'm going to read you guys the definition of the short sale rule from the website. And I will also leave a link in the video description so you guys can look at it and read it yourself. To sum it up, when SSR is activated on a stock, it pretty much means that shorts cannot slam the bid and cut the stock down. They can only short a stock on upticks. So they can only short on the ask. They have to short when the stock goes into strength. And when short sale restriction is on, and if you're messing with a low float stock, it could be very, very dangerous for shorts. And this is when you can see a lot of short squeezes happen. If you have a low float stock and the shorts can't slam the bid and they can only short into strength, if you have a bunch of buyers come in and they feel protected on the bid because the shorts can't whack it down, then once the low float stock starts moving up and shorts start covering and shorts start piling in, shorting into the strength, and it gets out of hand, then they have to cover their positions, and that's when you could really see it take off. So how does SSR get activated on a stock? I have a chart up right here just to show you guys an example. So how they plot it, if a stock falls below 10% or more from the previous day's close, they will activate SSR, short sale restriction. I have an example chart right here, CAPR. The stock closed right here. The next day, if the stock gaps up really, really huge, opens up like it did right here. If the stock falls below this previous day's close, 10% or more, which would be around down here, that's the area right here where they will activate SSR, short sale restriction, to where the short sellers cannot short on the bid. They can only short on the ask, and they can only short into strength, upticks. So now I will bring over Investopedia to give you guys the definition of the short sale rule. What is the short sale rule? The short sale rule was a Securities and Exchange Commission's trading regulation that restricted short sales of a stock from being placed on a downtick in the market price of the shares, which is the bid. Understanding the short sale rule. Under the short sale rule, shorts could only be traded at or above the most recently traded price of the security if the most recent price movement was upward. It forbade, with only limited exception, the trading of shorts on downticks in the share price. The rule was also known as the plus tick rule, tick test rule, or uptick rule. The rule went into effect in 1938 and was lifted by the SEC in 2007, allowing short sales to occur where eligible on any price tick in the market, whether up or down. However, in 2010, the SEC adopted an alternative uptick rule. It does not apply to all securities, and restrictions in trading on downticks are generally only restricted in narrowly defined circumstances, such as when the price of a security has dropped by 10% or more from the previous day's closing price. History of the short sale rule. The SEC adopted the short sale rule during the Great Depression in response to a widespread practice in which shareholders pulled their capital and shorted shares in hopes that other shareholders would panic and sell their shares quickly as well. The conspiring shareholders could then buy more of the security at a reduced price, but they would do so by driving the value of the shares even further down in the short term and reducing the wealth of former shareholders. The SEC began examining the possibility of eliminating the short sale rule following the decimation of the major stock exchanges in the early 2000s, because tick changes were shrinking in magnitude following the change away from fractions, and the US stock markets had become more stable. It was felt that the restriction was no longer necessary. The SEC ran test program of stocks in 2003 to see if removing the short sale rule would have any negative effects. After reviewing the results, it was decided that the rule no longer needed to exist, and it was dropped in 2007. However, naked shorting, selling shares short that don't exist or can't be verified, is still illegal. Controversy around ending the short sale rule. The abandonment of the short sale rule was met with considerable scrutiny and controversy, not least because it closely preceded the 2008 financial crisis. The SEC opened up the possible reinstatement of the short sale rule to public comment and review. As mentioned, the SEC adapted the alternative uptick rule, restricting short sales on downticks of 10% or more in 2010. Again, I will leave a link to this Investopedia definition of the short sale rule in the video description down below, and they also have other links to other definitions in related terms. The uptick rule, the downtick, zero uptick, zero plus tick, uptick definition. The uptick rule is just like the SSR. It requires every short sale transaction to be entered at a higher price than the previous trade. The rule was introduced in the Securities Exchange Act. It prevents short sellers from adding to the downward momentum of an asset already experiencing sharp declines. SSR, when activated, it was developed to control panic in the stock market. If the market's selling off very, very hard with sharp declines, they activate short sale restriction. That way shorts can't pile in on the bid and just destroy the bid, and the price just keep dropping and dropping and dropping. And this is why also they have volatility halts. The first 5 to 10 minutes of the market open, you won't really see volatility halts, but after that, stock moves more than, I believe it's 10% within 1 minute, then they'll place a volatility halt on a stock. I will make a video on that in the future. For this one, I wanted to break down the definition of SSR and the importance of knowing about it and keeping an eye out when it's active and when it's not on level 2, especially with low float stocks. If you're messing around with a lot of low float stocks, you have to know about SSR. I hope you guys enjoyed this video. Hit that thumbs up if you did. If you're new to the channel, be sure to subscribe to the Trading Learning 101 community, where we all grow as traders. Until next time, everybody, have that patience, have that discipline, and study, study, study. Later, everybody.
The most valuable commodity I know of is information. Wouldn't you agree?